All right, let's jump right into this explainer. We're going to uncover a massive banking secret that was finally documented back in 2014 by economics professor Richard Verr. He was inside a small German bank, and for months, he practically had to beg them to let him observe something that nobody outside the absolute inner circle of banking had ever seen before. He just wanted to sit in the room while a normal everyday loan was approved. Well, they finally opened their books, let him into their systems, and allowed him to see exactly where loan money truly comes from. And honestly, what happened next made accounting way more exciting than it has any right to be.
Because what he witnessed, and what the Bank of England actually admitted later on in their own official publications, completely shatters basically everything we've been taught about finance. The money didn't come from deposits, it didn't come from central bank reserves, it certainly didn't come from someone else's savings account. He watched his money that literally did not exist 1 second just magically existed the next. He became the very first person in history to document this happening from inside a real, functioning commercial bank.
So let's get into part 1, the illusion versus the reality of where money actually comes from.
You know, our brains really resist this idea. We're so used to picturing bankers in expensive suits guarding giant steel vaults full of cash. But when you get a loan, banks aren't temporarily borrowing somebody else's savings. They don't look at Linda's retirement fund and go, "Hey Linda, we're just going to borrow this for a sec so Jason can finance a jet ski in his midlife crisis." No way. Instead, they just open up a computer, type some numbers into your account, and instantly create brand new money.
Which brings us to part 2, understanding the 3 specific types of money.
If you ask someone on the street who creates money, they'll probably confidently tell you it's the central bank. But let's break down this hierarchy. Central bank reserves are basically a VIP lounge. Normal people like us never interact with them. Banks just use them to settle payments with each other. Then you have physical cash, the crumpled bills and coins sitting in your car's cup holder. And finally, commercial bank money. This is the big one. This is your salary, your mortgage, basically your entire digital daily life.
And when you look at how it's split up, it's pretty wild. Physical cash is just this tiny 5% sliver of the whole economy. The overwhelming majority, 95%, is entirely digital money. And it wasn't printed by some government press. It was created by private commercial banks the exact moment they issued loans.
Now you might be wondering, if they need our deposits so badly to make loans, why are savings account rates so, hilarious compared to inflation? The secret is simply that they don't actually need your deposits to fund their lending. We're all taught this classic fairy tale. You deposit money, the bank keeps a little in the vault and lends out the rest. But think about it. If that were actually true, if your deposits were the absolute bottleneck on how much a bank could lend and profit, they would be desperate for your cash. They'd be throwing free vacations and 12% interest rates at you. But they don't, because your deposits aren't the thing limiting them.
All right, part 3. Let's look at the magic trick behind all this. Double entry bookkeeping.
So if the money doesn't come from deposits, how exactly is this digital money just born out of thin air? The secret sauce is double entry bookkeeping. It's a rule that requires every single transaction to be totally balanced. If you add something to one side of the ledger, you absolutely have to match it on the other side. This seems like the most boring accounting mechanism in the world, right? But it's the exact engine that allows banks to create money legally and totally seamlessly.
Here's how it works in practice. Say you signed for a $20,000 car loan. The bank simply writes down your promise to pay them back as an asset on their sheet. Then, on the liability side, they record that they owe you $20,000, which is the deposit that just magically appeared in your checking account. That's it. No vault was opened, no armored truck moved existing cash around. The sheer act of typing out those accounting entries literally created the 20 grand.
Now, if you're waiting for the catch, okay, but surely they have to hold a certain amount of cash in reserve before making that loan, right? Well, you might want to sit down for this. In many major economies, that reserve requirement is exactly 0%. The primary question for a bank isn't, do we have enough money in the vault to lend to you? The only question is, do we actually want to lend to you?
Moving on to part 4. This is where a loan is really just 2 things hiding in a trench coat.
So you take that newly created money and buy that shiny espresso machine, the one that silently judges you every morning. But as you start paying that loan back, a fascinating split happens. The principal amount, it's effectively deleted from the economy by the exact same keyboard that created it. It just vanishes. But the interest you're paying, that stays behind permanently as real, tangible wealth, transferred directly to the bank.
And this leads us to a massive society-shaping question. Who actually gets this new money first? See,
Since banks still need borrowers who won't default, they hold all the cards. They get to decide exactly where new money enters the economy, and their choices completely dictate the shape of our world.
Put yourself in the bank's shoes for a second. Someone asks for 80 grand to open a restaurant. Terrifying, right? Restaurants are incredibly risky and often turn into empty storefronts with peeling motivational quotes on the wall. But then, someone else asks for $700,000 to buy a house. If they stop paying, the house doesn't just disappear. The bank just repossesses it. So which loan feels safer? Obviously, the house.
And this right here is exactly why housing isn't just a simple real estate problem. Because it's so much safer for banks to lend against existing physical assets, the vast majority of newly created money flows straight into mortgages. So you end up with this massive influx of new purchasing power chasing the exact same number of houses. Repeat that process millions of times across the country, and housing prices don't just go up, they accelerate into the stratosphere.
Finally, part 5. Let's talk about the real cost of all this, your time and your freedom.
When you strip away all the double-entry bookkeeping and banking jargon, this gets incredibly human. Every time you hit snooze on that early alarm, every single overtime shift you grind through is an exchange rate. You are trading irretrievable pieces of your finite life for a system where money is routinely just typed into existence. You treat your bank balance as a sacred store of your hard work, while institutions at the very top can simply press a few keys to create it.
Look, understanding how credit and money creation works isn't going to magically fix the whole system by tomorrow, but it absolutely stops you from playing the game completely blindfolded, which is exactly where winning starts. This system impacts the house you can afford, the business you can start, and the baseline freedom you have in your everyday life. If you don't understand how money is actually created, someone else gets to write the rules for you. And that leaves us with one final critical question. Now that you actually know how the game is played, how are you going to choose to navigate it?